Welcome back to Investing Talk Podcast.
Today we're looking at Treasure Global.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, let's unpack Treasure Global, or TGL. So, on the surface, this is a microcap software company.
Right, primarily in Southeast Asia. Think digital payments, e-commerce, that kind of thing.
And their main products are the ZCIDY Super App and something called a TZTE management system.
Exactly. But here's the thing, just calling them a payments company today is, well, it's completely missing the point.
Because their whole strategy has changed.
It's taken a very sharp turn. I mean, this isn't a small adjustment. Management looked at the low-margin grind of the payment space.
A tough place to be.
A very tough place. You're fighting giants. So they made a huge strategic pivot toward higher margin services. We're talking AI, GPU, and computing rentals.
Right, that sounds like a textbook small cap move.
Yeah.
You take your existing assets, in this case a user base, and you try to springboard into a sector that's, much hotter.
That's the play.
But talk is cheap. I mean, we hear this story all the time in the microcap world. What actual tangible evidence do we have that this pivot is really getting traction?
Well, the evidence just came in, actually. They announced an $300,000 AI and GPU order.
Okay.
And this came under their iSynergy SPA agreement. Now, $300,000 might not sound like a huge number.
In the grand scheme of things, no.
But you have to see in context. TGL's core business, their transaction revenue in the last filing, it was around $35,000.
Wow. Okay, so this one AI contract is almost 10 times that.
10 times their quarterly transaction revenue. It's a massive proof of concept. It shows real external demand for this new high-margin business.
That's a huge jump. But it also brings up the next question, which is always stability. With any microcap, especially one making an expensive pivot like this, you have to worry about cash burn, dilution. So how are the underlying financials holding up while they're chasing this AI dream?
This is the other side of the story, and it's surprisingly disciplined. Their operating leverage, their cost control, the improvement is pretty dramatic.
Dramatic.
Their adjusted net loss narrowed from $6.6 million last year all the way down to $2.1 million in fiscal 2025.
That's a 2/3 reduction.
A massive cut in their annual loss.
Hang on, let's pause on that. The word adjusted always makes me a little skeptical.
It should. It's a necessary skepticism.
Are we sure they're not just, selling off an asset or shuffling costs around to make the numbers look good? What gives you confidence in that improvement?
In this case, it seems to be structural. It's attributed mostly to cost optimization, getting leaner in their core ZCID and TZT operations.
So real operational efficiency.
Right. And when a company cuts its cash burn by that much, it just fundamentally changes the game. It extends their runway. It reduces the pressure to raise money at a bad price. It's efficiency first.
Okay, that's a good sign.
Yeah.
And did they manage to get any fresh capital to support this, or are they just running on fumes?
They did. And the source of the funding is what's really interesting here.
Oh.
They secured a $400,000 strategic investment from some Malaysian investors. Now, the amount itself is pretty modest.
400,000, yeah.
But the key part is who participated. The executive director, Chen Mengshun, he put his own money into this round.
Ah, so an insider, someone who sees the books, who knows the real strategy, is putting in fresh capital.
Precisely. It's what we call cluster buying in small cap land. It's one of the strongest signals you can get. They're not just selling the vision.
They're buying it themselves.
They're backing it with their own cash. It says they believe that a $300,000 contract is just the beginning, not a one-off fluke.
Okay, so we've got a pivot, we have a proof of concept order, we have dramatic cost control, and insider confidence. So now, the big question. The moat.
Right.
Southeast Asia is home to tech giants. Grab, Shopee, Alibaba. What stops these behemoths from just copying TGL's strategy and crushing them?
Well, their moat isn't really technological. It's not some new piece of software nobody else has.
It's not.
No, it's about deep, localized network effects. It's all about integration.
Okay, break that down.
It's built on two platforms. You have the ZCIDY Super App for consumers, think rewards, payments, all in one. And then you have the TZTE platform for merchants.
And what is TZTE?
TZTE handles the back end for restaurants, cafes, all the F&B outlets, order management, point of sale, loyalty programs.
Ah, so it's sticky.
Very sticky. Once a restaurant is running on your software, they really hate changing it. High switching costs.
And on the consumer side, with ZCIY, what's the scale we're talking about?
It's significant for a company this size. As of early May this year, they had over 2.6 million registered users.
2.5 million. That's a pretty captive audience.
It is, and it allows them to cross-sell. If they roll out a new AI marketing tool, they've instantly got a base of merchants and users to pitch it to.
But the real mode, I'm guessing, is the partnerships. Is this just, a logo on a website, or is it deeper integration?
It's the depth. That's what matters. They have partnerships with regional champions that are just incredibly hard to replicate.
Like who?
We're talking Shell and Petronas for fuel, Grab, Lazada, and Shopee for e-commerce, Family Mart for retail, and crucially, they're integrated with major banks like Maybank and HSBC.
That's the key right there. Banks and big oil companies don't just partner with anyone.
Absolutely not. Think of it like 1,000 tiny little speed bumps for any competitor.
Right.
Their services are already embedded in how people in the region live and shop. For a giant to come in, they don't just need a better app.
They need to spend years rebuilding all those individual relationships.
In integrations. That localized trust is non-trivial. It's a real barrier.
So the whole thesis is they use this deep, entrenched local network, their moat, to start layering on these new high-value AI services.
That's the blue sky scenario. They stop being just a digital loyalty card and start becoming an essential data-driven partner for all these merchants.
Okay, that's a compelling bull case. Now let's flip it. Let's be brutal. We both know these kinds of pivots in the microcap space often fail. Execution is everything. So where does this plan fall apart? What's the bear case?
The biggest, most obvious risk is their current scale. It's just tiny.
That 35,000 in transaction revenue.
Exactly. While the loss reduction is great, the revenue base is still extremely small. And that means there's a constant risk of dilution.
They'll need more money eventually.
They will. And if those AI contracts don't ramp up fast, and I mean over the next 3 to 6 quarters, they're going to have to raise that capital at a bad price, and that will punish the stock.
So they're basically running against the clock. They have to scale that AI revenue from 300,000 to, say, 3 million, and do it fast.
That's the race. And they're in hyper-competitive markets, payments, e-wallets, and now AI services. Giants with deep pockets are everywhere. If they can't execute, they could just get stuck as a niche player.
It really sounds like a classic asymmetric setup.
It is.
If they pull it off, the upside is huge because nobody's really watching them. But if they stumble, the downside is severe. So given that risk-reward, what's the market sentiment like right now? What are the technicals telling us?
Well, the overall perception is pretty neutral, which you'd expect for something this under the radar. The stock's volatile, it spikes on news, but the interesting part is what's happening beneath the surface with institutional flow.
What are the institutions doing?
Quietly, they're accumulating. If you look at Q3 of 2025, institutional holdings went up. Not by a massive amount, but the trend is there. We're talking an increase of over 35,000 shares. It suggests that the specialist microcap funds are building positions.
Getting in before the story gets out.
That's what it looks like. They're betting on this pivot while the broader market is still on the fence.
And what about the recent price action? Has the volatility created a potential entry point?
It seems so. The analysis out there suggests the stock went through a pretty big correction recently. The conversation is now about whether it's attractive after a correction.
Meaning the hype ran ahead of itself, and now it's reset.
Exactly. It pulled back, it stabilized, and that suggests a reset of expectations. For anyone who believes in the fundamental story, this could be a more attractive entry point, with some of that initial speculative heat gone.
Okay, so wrapping this up, if you're an investor watching this story, what are the 1 or 2 critical things you need to see in the next few months to know this turnaround is real?
First and foremost, you need more proof points on the new business. Quarterly updates have to show that the AI and GPU contracts are ramping. Was that a $300,000 order a one-off, or is it the start of a trend?
More contracts.
More contracts and clarity on that revenue ramp. And second,
Financials.
Yep, they have to keep proving that loss reduction is sustainable. Show that the low cash burn is the new normal. That keeps the dilution risk at bay.
So to summarize the whole thing, Treasure Global is trying to shift its entire identity. It's moving from being a small, low-margin payments player.
Albeit one with a 2.6 million user base.
Right. And moving toward being a much higher value AI and computing provider, all while slashing costs and seeing insiders put their own money in.
But the conflict is scale. The risk is that they're still just too small to fight the giants. The opportunity, though, is all that unpriced upside if they actually pull it off.
So What does this all mean for you, the listener?
Well, this is absolutely a 12 to 24-month play. It's for investors who are comfortable with speculative high beta risk. The ultimate question for you is this. Do you believe that the financial discipline and the insider buying, combined with that moat of 2.6 million users and deep partnerships, provides enough of a foundation to support this very aggressive AI pivot?
The structural advantage versus the execution risk. That's the trade-off.
If that's the whole game. If you want more of this kind of targeted market analysis, be sure to subscribe and follow Investing Talk podcast wherever you get your audio.